CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
Hello, everybody. Welcome. Good morning back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks, the leading digital asset index provider. Today, we've got Mark Pilipczuk, the research analyst on the team, Tomas Perfumo, the chief economist for Kraken. And joining us in the second half of the hour, we're going to have Mike Treidl, who is the CIO and founder of Blue Coin Capital. He's back for a second week. Last week he felt like he was a bit robbed for only joining for a half hour, so he's coming back to do the second half again this week, and we're excited to have him. This week we've got a lot on the docket. We were going to talk about what's going on in the macro environment. We're seeing a lot of, I think, dovish cues flowing through the headlines this week. So you're seeing that disinflationary signal. We're also going to break down some of the things that we're seeing in the Q2 earnings season so far. We're also going to talk a little bit about the perps DEX landscape, and that's going to be a pretty good topic to jump into. But first things first, I want to just kind of kick things off with the news that we got this morning with the June retail sales print. It was plus 0.2% on the headline. According to the Bureau's own footnote, that is statistically no different from zero, depending on how that breaks. And we're seeing kind of just like a softer easing in consumer spending. Tomas, I want to throw it over to you. What stood out to you as far as this report? Are you seeing? Is this something that we could materially take away that the consumer is in fact weakening and not accelerating?
I didn't take much away from it, to be honest, mostly because I think the inflation story is the one that's like capturing all the headlines and really making the let's call it the difference in terms of the monetary outlook. So I kind of viewed it as like a ho-hum report myself personally.
Yeah, so the thing that you have to think about when you look at the retail sales figures is that it is a nominal figure, right? So it gets impacted by inflation in a sense that when you have rising gas prices, that's going to push retail sales artificially higher, or you could say it increases at retail sales. And then when you have falling gas prices, it drops it. So one thing to look at is that control group figure, which I think rose at 0.5%, which of course is not a bad figure on a month over month if you annualize that. What I took away is that we're starting to kind of get a real picture of how that recomposition and growth happened in the last quarter. Because if you think about how the control group flows into the actual GDP statistic, if you look at the GDP now, as of this morning, it's still hovering around 1.3%. So we're getting all those puzzle pieces that you kind of collect throughout the quarter to kind of get us to a more, let's just say, confident reading or measure on the nowcast. And certainly growth in real terms has decelerated, but growth in nominal terms has probably stayed mostly the same in Q2. It's just the recomposition of growth. We're seeing more going towards inflation and less going towards real. Mark, on your end, were you surprised at all by some of these figures?
Yeah, not really. I didn't. I wasn't really watching the retail sales as closely. I was with Tomas, where I was more looking at the inflation data and the story that's starting to tell. Although my thing with the inflation, with the recent inflation data that we got is, yeah, we saw core CPI and everything basically flat and headline CPI down last month. But with the recent escalation in Iran, it's still largely a geopolitical story when it comes to inflation and really all that stuff, right?
Yeah, that's something that we should probably jump into next. So, looking at inflation and the rates market's one thing. Got the 2 year now trading at 4.145, down from 4.23, which was, I think, the cycle high, 52-week high. 10 years now at 4.55, and the 30 years above that 5% handle, which is significant when we look at who's kind of like the marginal buyer and who the marginal seller is above 5. We know that a lot of pension funds like to step in there, so that's something to kind of keep an eye out on. But let's just jump into kind of what gave us this kind of term structure on the treasury market, because um, Tuesday we got the CPI, right? Or I'm sorry, yeah, it was Tuesday. We got the CPI. We saw the biggest monthly drop in consumer prices since April 2020. And core, which is the part that the Fed actually watches, was flat for the first time in more than 5 years. So I guess the question, I'll throw it over to Thomas. Tomas, is inflation actually in the rearview mirror? Or are you also kind of seeing what Mark's saying, where the geopolitical uncertainty is going to continue to kind of keep this thing in check?
Yeah, I don't think it's in the rearview mirror, only because we just don't have a confident resolution in this situation with Iran. But I think what's, I guess, encouraging for the market is, with the June print, what's special about it is you kind of get a glimpse of what things could look like if you get a good outcome, right? Because there was this kind of, I think, growing concern that, hey, even if we get oil prices in line, I now have to deal with higher pressure of inflation, potentially from the AI investment cycle, which was like kind of a growing category that was being referenced in the recent meetings. And I also don't have, 100% line of sight on when the tariff-driven inflation would start to lap from the news last year, the imposition of tariffs. And I think what people, like I said, caught a glimpse of is, hey, in a month where oil prices were notably lower, and you also had the kind of ceasefire conditions starting to like prove out with traffic growing in the Strait of Hormuz and whatnot, we were able to get a much cooler than expected inflation print. And so I think people, in some respects, almost had a glimpse of let's call it like a additional glimpse of hope that if we were to get the geopolitical situation resolved, that you might actually see a stronger disinflationary trend than people were expecting. But that doesn't take away the fact that we still remain in this like very uncertain condition around energy markets. And you can say pour all you want, but the consumer is the one that still pays for gas, so it's still going to exist as a problem.
Yeah, Mark, what do you think?
Yeah. And then, yeah, another thing that we can, I think that some of the tariff impacts are starting, or the falling off of the tariffs are starting to show up, because if we think back to when the pause was, that was late April, and then they kind of came up with some final tariff numbers around May, June. So I think we are starting to see some of that roll off. And then the other thing that is a potential positive for us too is we saw that huge increase in memory prices. And this was about like November of 2025, call it early 2026. We really saw those start to pick up. So we could be looking in, just a few more months, another 4 or 5 months, we could start to see some of those effects normalize as well. And we could get a pretty cool inflation picture if the energy market can stay in check.
Yeah, I think, look, there's no question, if things continue on the path that they're on, July's CPI is going to be worse than, or let's just say higher, depending on if you are trying to be dovish or hawkish. That seems to be shaking out, especially with oil prices trading, I think, near 85 now. The thing that I think is encouraging is, one, if we want to stick on just the energy topic, is the impulse of the price moves, given the headlines that you're getting out of the Middle East. So you're not seeing these extreme gap ups in oil prices, in the triple digits. It's really kind of incredible to see how, I think, visible inventories itself have kind of rebuilt, despite the fact that we've had a continued, I would say, mostly shutdown of passages through the Strait. I think we were only seeing at peaks like 25% restoration of the the volume traffic going through there. And so the markets definitely seem to be pricing in the crude markets seem to be pricing in a resolution that's going to either eventually manifest and stay, or the demand for oil is just materially weaker than we all expected. I mean, the third thing is you could argue that the markets are clearly mispricing these things, and we'll be back at $110-$120 a barrel before you know it. And if that's the case, that certainly I think will change kind of our base case view from a peak inflation, peak rate standpoint. Right now, if you look at the CPI report, it was pretty encouraging to see the percentage categories of goods that are either not decreasing month over month, which is kind of like the breadth measure, or you can bucket them between the 1% to 2% or the 2% to 4% or greater than 4% buckets, and you're seeing just a broad deceleration in price increases month over month. So if you think about what the Fed has control of, they don't really have control of the energy picture, and therefore they tend to not focus too much on that. The things that they kind of are concerned about are kind of like the core pieces of inflation that are stickier, and with that you've got a labor market that reaccelerated largely, but now is starting to look weaker. And we've got a great chart in our outlook where we show the month over month changes and non-farm payrolls, including the most recent one after the revisions. And you can just see this steady deceleration in jobs growth. If you look at the quits rate, it's just extremely low. I think it's hovering at like 1.9%. So again, like the precedent of having kind of a re-acceleration in these, like a wage price spiral or re-acceleration in broader inflation that would trigger a rate hiking cycle, is just really not there outside of the supply shock that's coming out of the Middle East. And even with that, I still think we have to be a little bit wait and see. And so I would like to see a weekly close. If you want to know my benchmark is, I want to see a weekly close above 85. I think we're trading around 84 right now on Brent. I might be wrong, but when I last checked, it was just below it, and I want to see if we can kind of persistently stay above that.
Yeah.
What do you?
I would add, I mean, like this is obviously like we're talking a very US centric view here. I'm seeing like also reasons that this is bifurcating in a complicated ways, particularly for Asia and Europe. Like for example, diesel markets becoming increasingly impacted by Ukrainian strikes on Russian refiners and Russia banning the export of diesel, causing a pretty large spike in diesel prices. And that's not really as much of a US issue, but it's going to create this kind of like bifurcated policy world that we're seeing right now, which is you're seeing hikes in Japan, in Europe, and you're seeing the Fed in the US trying to kind of coast while we learn more about what's happening. But the hard part with commodity markets like oil that I think people don't realize until it's too late is that the only thing that kind of keeps oil moving in a linear path for the most part tends to be this like inventory matter. And
Mhm.
when inventory is low or too high is when you get those kind of step change functions. So COVID, that legendary time period where oil futures were trading like substantially negative, when inventories were basically to the brim and there was just nowhere to put the oil, right? And price is the only thing that's going to help chill out the volatility. And it's going to be the same thing here, where as long as inventories are okay and can withstand like these kind of marginal pressure points that we're seeing out of the region, then you're going to have this kind of linear at the margin. Maybe inflation's a little hot or a little cool, but what really sets things off is when you have inventories like way too tight and you have some kind of escalation happening at the same time, and oil can go very quickly from 80s to above 100 and well excess of that. It's a very at the margin market. So
Yeah.
that's where the uncertainty really comes from.
you've hit on this point a few times, which is a really great point, and I want to go into it. But before we do, yeah, you're referring to the Cushing, Oklahoma oil hub, and I remember working on Wall Street during that day. Well, we were working from home because it was April 20th, 2020, and we had the shelter, or we're still kind of shut down in New York City. Negative $37 per barrel. The oil barrels, you could imagine, probably just completely uh, stacked to the roof in these warehouses in Cushing, Oklahoma. That was extraordinary to see, and maybe we'll never see that again in our lifetime. But you've touched on this point a few times, Tomas. You're absolutely right. Look, there's the crude price of oil and there's the refined price of oil. And what you're referring to there is with diesel prices or you're talking about gasoline prices, that's the refined product. And that's the product that actually people pay, right? They don't buy crude barrels of oil unless you're have some kind of, I would say, far-fetched thing going on. But yeah, in the refinery picture is not looking great. I mean, if you just want to look at the United States, we've lost a lot of refineries, particularly through the COVID cycle. And when you look at the rest of the globe outside ex-US, those they're not in any particular better position as well, particularly with the jet fuel and diesel fuels. Those are likely to stay elevated. But I guess the question is the step change of what inflation is, right? It's a rate of change measure and these prices. And so long as what you're saying, the inventories can stay relatively imbalanced, then you won't have that rate of change impulse that feeds through into an inflation print.
Yeah, at least not in the dramatic way that would cause like some kind of very significant like pressure point to collapse. I just think that that's the part that when you have these supply chains, they're so complex, you just don't know until it happens. It's very hard to predict. And so the best thing you can do, from like an investor standpoint, is just cool off risk.
Yeah. Another thing that is very, I'd say, adjacent to the topic that we're discussing right now is the Fed speak that we had this week. So we had Waller give a speech on Monday where he sent a pretty clear signal to the market saying, if the June print is above market expectations, you should expect us to try and hike rates. It's probably safe to say now, and you can kind of confirm this with the CME Fed Watch tool, that's no longer the case. So that kind of pushes us, into September through the Jackson Hole Symposium in August, and so we have a little bit of a runway here as far as like Fed certainty. My question to Mark and to you, Tomas, is do you think that this kind of let's just say display of Waller, basically giving us the playbook ahead of time is kind of maybe stepping on Warsh's toes a little bit, or you have a new Fed chair who's trying to, I'd say, change the forward guidance and give less forward guidance and the reaction or somehow evolve the reaction function of the Fed. But it's when you have members like that who speak out, it's just kind of interesting to see if that's going to start maybe any drama inside the institution.
Yeah, I thought it was interesting that Waller actually came out kind of hawkish on inflation, because when I look back, he's typically been a dove in the past. So it was a bit of a change in stance from him.
Well, we all know.
But
I have my
yeah,
theories on that.
yeah, but I don't know if this would really cause too much of a discourse in that committee, right? Or like a dysfunction within the committee. I think it's actually pretty healthy that there is some disagreement on the way that they do things, and then the way that they speak. I mean, you want to see everybody kind of taking a more independent view. So if anything, this kind of strengthens your case for Fed independence here. But yeah, he did and he also came out right in front of an inflation print, which can always go one way or the other when you speak on these things. But and then you also have to consider too that what I think that they're trying to do is really manage the consumer's inflation expectations, because once you start seeing prices run away, and once inflation expectations go, you'll see that pick up in demand for people trying to get ahead of it. And then from there, you can really run it way out of control.
Tomas,
Yeah,
what's your
I
take?
personally didn't make too much out of it. I mean, I think some of these folks like to speak a lot. And they kind of just like use, lagging indicators like prior prints and then their commentary as well. If we catch a few more of those, then we'll make a decision. But that's been the status quo for a long time now. Um, and what I had discussed in the past was prior to Kevin Warsh taking over the Fed chair was like, do we get a new regime change where we might actually have a pretty significant dovish majority, which I think Powell kind of torpedoed a bit by staying on the board. And I think these comments like don't change the fact that Warsh is the chair and he sets the agenda for the meetings and he determines, what they're going to vote on. And so that's kind of again, I'll point you back to that first conference that he led, or the first press conference back in June, which one of my biggest takeaways was he made the comment that they only had one proposal that they voted on. And and I believe he mentioned along the lines of that historically it's common to have alternative proposals be discussed. And you can imagine like from a dynamic on the board, you are going to cast a vote and the person who is setting the agenda for the meeting is saying, you get one vote. Or excuse me, you get to vote on this one proposal. That's it. We got no alternatives here. And so, people can say what they want. I think at the end of the day, Warsh is going to leverage his position as chair and setting the agenda, what they're going to vote on, as really the determining uh, factor or force on the direction that things are going to get taken. And his job is to assess in his job as a consensus builder whether he's going to have the votes in advance to be able to get something passed. That's kind of how I interpret
And if you look at the votes in the last meeting, it was all in agreement. It was like it was you didn't have any dissents. We've had a lot of dissents in the prior meetings, and now we're seeing that kind of conform. Look, I think it's going to be interesting to see how Warsh and his task force, you know, um, present themselves with ideas, recommendations on how they could evolve or change the frameworks of the Fed, how it could impact the balance sheet and all the traditional open market operations that we've seen in the past. It's been pretty quiet these past few years. We've only had a few instances where the central bank really needed to step in and provide maybe some repo funding liquidity, which would be kind of like those short-term overnight uh, type facilities to help keep the plumbing good in markets. But I could easily see, if I wanted to be a little bit cheeky, I'll borrow the term from my British coworkers, that if you are a new Fed chair joining an institution and you're in the situation that he was in when he joined back in May and did his first meeting in June, where look, the inflation picture does not look very favorable, and the labor market's also not really cooperating in the sense that if you try to benchmark that and say that look, we need to start considering the labor market weakness, I would try and be probably as unclear as possible about forward guidance. I would use that tool every day. I would tell the public, we are going to trim down, the words of the economy when we release our statement, which is what they did, and kind of leave a sense of ambiguity. I think that's a really powerful tool to stall and to kind of maybe let some of these supply shocks work their way through the system. We've seen that happen with June CPI, and we know that July is probably going to be different. But at the same time, I can't help but wonder that's probably a pretty effective strategy if you don't want to sound um, if you don't want to give the market too much of a read on what you're thinking, and just kind of keep everything in check, if
it.
that
Yeah.
makes sense.
Yeah, I would just add just, to your point around the decision in June being unanimous versus what was it, 8-4, I believe, the prior month. The prior meeting rather. The interesting thing to consider is that the dissents were effectively satisfied by the exclusion of the quote unquote easing bias in the statement. So just the notion that by removing language suggesting that you were directionally biased in one direction, like quote unquote forward guidance, you placated the concerns of 4 members of the FOMC. And
Yeah, that's a
so
really good point.
if I think about this July meeting, oil prices are up week over week or over the last 2 weeks, but they're certainly nowhere near where we were back in what, May,
Hmm.
May, early June timeframe. And so when I think about, hey, like the last decision unanimous and all it took was getting rid of forward guidance, I struggle to think that we're in like a materially worse situation that would cause people to think that we actually require a rate hike near term. I think people just want to sit still and see how the geopolitics play out, and that they feel like we're either marginally tighter than we need to be or marginally looser than we need to be when it comes to policy. But they just need to see like a trend play out, and I think the geopolitics are going to be what sets that trend when we get like a more certainty around the next stage of whether it's peace or escalation.
Mark, I'll give you the final word if you have anything else to add, and then we can maybe jump over into the earnings topic.
No, I don't have anything else there. I think we've covered it. Let's get into earnings.
No, that was really great. Thanks, guys. Mike should be joining us relatively soon, so we'll try and have him join in a manner where we can also kind of get his take on what's going on in markets, since he runs a fund. It's certainly going to be a lot of value add for listeners to get that kind of perspective. Look, let's just go into kind of like some trends that we're seeing in the so far in Q2. Earnings growth it's pretty much been priced for a pretty strong season, where I think FactSet has 23.6% as far as like a blended implied figure. If you look at the historical beat rate over the past 5 years, you would actually get near 29%. We know that sell side analysts typically have lower hurdles for companies, so beats are actually more common than people perhaps may think. And so yeah, we're looking at a result here with earnings growth coming in quite strong, which really keeps the PE ratio of the index relatively in check. And so one of the things that I was kind of blown away at, I guess, is kind of like my my key stat of the week for what's happened so far, is we saw that Goldman's equity financing revenue grew 91% on prime brokerage balances, and the equities desk revenue grew 45%. Morgan Stanley also beat on its own equities estimate by nearly $2 billion. And I think it's just a really kind of interesting thing to see how the volatility in markets has really become a tailwind for these big bulge bracket names. Mark, when you check back and look at these earnings so far, do you think this is going to be a new run rate with these bulge bracket names, or do you think this is more like a one-off quarter event?
It seems to me that there's this particularly strong quarter we saw. I don't know how hard how it's going to be to top that or to continue that type of performance. It might be possible. One thing that I've really been watching going into earnings, though, are some of those analyst estimates and where they've been revising them heading into earnings season. So over the past several quarters now, what we typically see is we'll actually see analysts begin to cut estimates as you head into earnings season. But this quarter around, we actually saw them slowly raise earnings estimates, about 2% over the last few weeks / month here heading into earnings. So it seems that we are starting to accelerate, and we see the market expecting these companies to deliver on results. The other thing that I'm like really looking at in this earnings season is going to be out of the AI hyperscalers and look at their CapEx plans specifically. So right now we've seen around 775 billion in announced CapEx over the next 12 months. We'll see if they alter any of those or announce any altered plans on those earnings calls. The other thing that we're going to kind of want to start to look for is this AI data center build out's been going on for almost 4 years now. We're going to want to start to see what some of the ROI looks like on these things. I've seen many charts where I've seen free cash flow on these companies going down as CapEx has been going up. What's the ultimate resolution of that going to be is what I'm looking for.
Tomas, I want to get your take here on the finance names. They're the ones that always go first in any earnings season. Sometimes you get a sense of how things are going to continue for the rest of the names in the large cap space. And sometimes it's a bit of a surprise. But lately it's been a surprise to the upside, especially with the AI theme that we've seen. Were you surprised at all by the strength that you're seeing out of these bulge brackets?
Not too particularly, mostly because I mean, when I think about like some of the underlying businesses that and just the trends that we've been seeing, like we're in an uptrending equity market with probably at or breaking records in terms of issuance in the first half, capital raising and whatnot. And you have the brokerage business that's probably on fire, and you have a massive investment cycle happening with AI. And so like along all of these different, and I think was it JP Morgan that indicated that every single segment they have is breaking records.
Yeah.
And so I think the from the banking side, it kind of speaks to like just how robust, though volatile, capital markets have been year to date and following that trend. And it's my guess is that AI has like a massive, massive part to do with all of this. So I think I agree with the comment made earlier that it's hard to say what direction things go because they've kind of like perhaps like lead the trend, and maybe it's a harbinger of like a deceleration to come. But the question from my perspective is more aligned with what Mark just mentioned, which is I care more about like the overall aggregate CapEx figures that the big tech guys are going to be putting out there, and seeing if there's any kind of break in trend or if there's any kind of commentary around their conviction and or ability to raise capital near term.
Perfect. Look, I think that leads us right into the next topic for earnings. I'm not sure if you all saw, but Gartner is like a research consulting, tech consulting company. They put out a report earlier this year that highlighted that half of generated AI projects die after proof of concept. That's up from 30% from a year ago. We're seeing a lot of CFO chatter coming out. Uber is capping their employees' monthly spend on tokens. Amazon, Walmart, Cisco, Meta have trimmed their internal AI tools. It seems to me like we're getting a bit of a reality check with these budgets internally at these companies. As far as at first, it was like a blank check, being like, okay, let's just start running, frontier models all day. For whatever use case you may have, it's becoming a different world now where the token spend, despite the fact that token prices have gone down, according to some indices that you can track, is actually causing companies to it's causing a headache for CFOs because they're not really sure what the budget right for their AI spend. I just want to ask you, do you guys see are we going into peak AI spend here in 2026, or what do you see?
I think it's pretty likely we start to see that AI expense line items start to come down over time. Really, like a lot of what I think that earlier spend was experimentation. When it opens up so many new capabilities, your team can ship things a lot faster. You could build things that you previously couldn't. You might be able to operate with a smaller team. So like naturally, I would think that any any CEO would want to try to experiment a little bit with this and see what they can get out of it. And in doing so, it's okay to make a little bit of investment and maybe spend in areas that wouldn't return. But now we're starting to get a little bit of a picture of what that productivity gain looks like. So this might continue for a few more quarters while we experiment, especially as new tools come out, new models. A lot of what started this spend was the rise of all of these agents that you're seeing running in Claude Code, where you can now spin up a swarm of 20, 30 agents and burn millions of tokens in seconds. That's really what was doing it for me. So it'll be a combination. It'll be a combination.
So you sound like you know from experience.
I do know from experience. I've seen my Claude usage go crazy after one prompt, where it takes a wild direction. But yeah, that's kind of what I think. I think we'll see spend start to normalize with the current iteration of the tools, and then as this technology continues to advance and we continue to change the way that we use it, we'll probably see the spend pick up again in the future while we try something new and then fall back down. And we'll probably see this cycle continue for a number of years until we hit that equilibrium.
Yeah, I would also just add that I think we're now getting to an interesting point in the story here with AI, where we've seen how these cheaper models, really coming out from China mostly, are able to maybe just be a few months behind the leading frontier models that are here in the States. And the first signal that I'm paying attention to is, in fact, what people are saying now, as far as the reconsideration, the rebudgeting of tools. And it leaves a pretty, I would say, pretty big risk now that you start to see a more of a race towards substitution for cheaper models as a way to offset your increase in budget costs, to try and find ways to offset that and find cheaper alternatives. The reason why this is important is because if you remember, we've been spending trillions of dollars in this AI CapEx build out, and the hyperscalers have certainly initially benefited, but are now starting to see some relative underperformance in their price. That to me these are all kind of like herrings that I'm kind of starting to see a little bit of like, is this the beginning of dominoes starting to fall, where we have to kind of reevaluate the return on investment from all this huge CapEx spend. And I know earlier in the year, Tomas, Mark, we've had kind of candid discussions privately talking about risks to the economy, risk to growth, if this AI industry kind of becomes a bubble. And if you think about what could pop a bubble, it's kind of a recalculation, a re-realization of the return on investment of all this extraordinary spend. Tomas, I don't know if you've got any other viewpoints on that, or if you see also kind of like any early cues coming from what we're hearing from AI budgets being capped.
I haven't seen like early cues of a larger trend of like people hitting some kind of wall when it comes to productivity growth. I get your point on like the budget. I think there's one thing to consider, which is like AI tools are kind of like an amplifier. So if you have like an all-star individual using AI, you amplify how good they are. And if you have someone who is just not talented or doesn't have good taste, you just get a bunch of slop. And so it almost, it's kind of like a good litmus test for like performance of an individual based on how well they're able to leverage the tools. And I think we had this first wave of, hey, AI tools are really dedicated towards engineering tasks and working with engineers and boosting the productivity there. And they tend to also be, I think, better aligned with using the tools more effectively. And that started to broaden out into every employee should be using it. And so naturally we're taking perhaps like a half step back of like, okay, maybe every employee can use it, but maybe certain employees will get the older models, so the token cost is not as high.
Do you
But
think there's going
I
to be
think,
an
go
audit
ahead.
function in
I don't
internal?
know.
Like,
I think
why did you prompt Fable 5 Extra to write an email to your
I mean, it's just
coworker.
gonna be super easy when it comes to just looking at a dollar budget. And that's I think that's the easiest the point that I would take away anyway is that when a CFO like sets a budget, like a monthly budget per employee or something, what
Yeah.
they're basically doing is like a very blunt way of saying, hey, I don't want to go and audit like which models you're using. You just get this amount of money to spend. That's it.
Mhm.
And if you're capping it out in a single day, well, like you figure out how to like make that more efficient. So I think that's more of the exercise that we're going through right now as we're broadening the exposure of these tools. But the broader trend of like people having hit some kind of ceiling around their learning and whatnot, I don't think we've reached that, mostly because like the models continue to improve. And so we're still learning different capabilities that we can extract from using these tools. At least I am. So that to me, I have pretty strong conviction in. But I think one thing that might be scary for these AI labs is also recognizing that the switching costs are pretty low.
Yeah.
It's a highly competitive industry, and people are doing a lot of benchmarking of these different models and how good they are on even on like a normalized token basis.
Yep.
And so it's like and that's within a single day of these new models getting released. And so it's really easy to just say, hey, new model got released, here was the benchmark. Everyone, start using this model. And it's you just flip the switch.
Yeah.
So I think that's the biggest problem for these AI labs, candidly speaking, is that the cost to switch and substitute is really low. Um, and so that to me makes it difficult to capture long-term like token premiums, so to speak, unless you have some legitimate moat in terms of how far ahead your frontier model is. And from the benchmarks I've seen, it seems more at the margin at this point amongst the most competitive ones. It honestly reminds me of Bitcoin mining, ironically.
Yeah, that is a good point. And it is something that I feel like, candidly, we've had discussions where we've been talking about the the constant releases of new models and how it keeps everybody in check. And then later on get like an iteration of a competitor creating a model that's like 90% of a frontier model, but like 10% of the cost. And so the competition angle that's currently happening in the industry is pretty awesome to see from a consumer standpoint, because it gives you a lot of choice. And if you were to imagine a world that was different, where one frontier lab basically had the moat locked up, like you were saying, Tomas, it would be, gosh, that would be kind of a scary world to live in if you think about it from a consumer perspective. Mike, I see that you have speaker privileges. Are you able to do a quick sound check?
Sound check. 1, 2, 3. Can you guys hear me?
Yes.
Great.
Welcome back. We were just wrapping up the discussion on Q2 earnings. We were talking a little about AI and some of the news that we're seeing about, um, internally. You're seeing some companies start to cap budgets, and I brought up a point just saying, is this kind of the first domino to fall for the AI bubble? When you think about all the CapEx that's been deployed in the industry and the assumed return on investment that these projects have, if you start to realize either um, an increasing or an implementation of caps, fixed caps to kind of curb further spending on AI, or B, you start to see competition from these like Chinese models that are much cheaper, that would potentially derail some of the hyperscalers' plans in the U.S. here.
Yeah, it's a really interesting situation. I mean, it could be a bubble or it could be a slow deflation, right? Just kind of letting the air out of the bubble slowly rather than popping. Um, yeah, I think with the Chinese models, there'll be potentially security concerns. We saw things like with Huawei chips in the past, so it's hard to know how the government will respond to that. And I'm wondering if AI will try to find new ways to make it harder to switch, right? Because right now, you own your data. You can, if you want to switch from Claude to Gemini, you can just download your data and then move it over. In theory, I personally haven't tried it, and these AI models do a great job of trying to get to know you, right, and learning and remembering everything you've said to them, and so to the extent that you can easily port that over, it makes switching costs very low. But if they can find ways to make that more challenging, then they can start to build a little bit of a moat, maybe try to create some kind of a walled garden like you find with Androids and iPhones. They've got a lot of smart people thinking up how to do this every day. So we'll see what kind of comes down the pipeline in terms of that.
Oh, good stuff. Now, I know you're going to be heading out at the top of the hour to join another webinar to discuss the MicroStrategy strategy.
Right.
Is MicroStrategy on the right strategy? This week we saw them hit the ATM on the MSTR side, so we're selling the equity shares to raise cash. I guess, could you give us a preview of what's going to be discussed in the next webinar that you're going to be joining?
Yeah, absolutely. So the situation's still unfolding with strategy. As you may recall, at the beginning of this month there was this steep sell-off and stretch, and NAV premium compression of the common equity MSTR. And back in May they sold 32 Bitcoin to inoculate the market. In July 6th they sold 3,500 Bitcoin for about 200 million. There were a lot of people at that time screaming capitulation, that there was going to be a slow bleed. But then this last week, as you just referenced, July 13th, they raised 466 million from MSTR ATM, right? Without touching or selling a single Bitcoin. And what this is part of a broader movement away from, they're evolving from a one-way capital issuance to active capital management, right? So if going back to the flywheel, if the MNAV is trading at a premium, then it makes sense to issue shares, whether that's to buy Bitcoin or service debt obligations or obligations on the preferred. If MNAV's at a premium, it makes sense to sell that. But if MNAV is not at a premium or a discount, then it makes sense to actually sell Bitcoin. So now they have two different levers to pay these obligations, and they're demonstrating that at scale with the size of these cash issuances that they've been doing. For USD reserve now up to $3 billion. So Stretch and these other obligations have a 2-year runway of just cash to pay the obligations. So they're really doing their best to instill confidence in investors, especially in Stretch, that the chances of any kind of pause on the dividends is very low.
Yeah, it's definitely buying, I think, time here. Tomas, I want to get you in on this because you are, I would say, our expert here on also things strategy. Were you surprised at all by the news this week?
That they issued more common equity? Yeah, I was candidly. I think my perspective is more from a coming from a what are you going to do with the cash, or how are you going to deploy it? The choice to increase the USD reserve, I don't personally see the benefit of doing so, mostly because the policy of designating that 400 million of incremental cash as quote unquote USD reserve prohibits them from using it towards anything other than interest payments and dividend payments. And so if you ask me like what I would prefer to see, given the news that they raise money, is that they're actually stocking up cash to go repurchase more debt, for example, more of the convertible debt. But they chose to put it and designate it as this USD reserve cash. And I think one of the interesting comments I think I read either this week or from last week was this reiteration of a commitment to bring STRC back to par. And personally, I just don't see how the USD reserve increasing it by any number of months um, is really going to do that. I fundamentally just think it's either you have Bitcoin price recover or you just continue to hike the dividend rate. I think this concept of like extending the runway from 18 months to 21 months or whatever it might be isn't going to fundamentally get you a re-rating back to par. I think the runway's already been sufficiently
So,
stocked up.
so at the top there, did you say that these new funds cannot be used to buy Bitcoin?
No, when they designate it as USD reserve, the policy that they have for the USD reserve is that that money is there for interest payments and dividend payments. But it's
Wow.
not
Okay.
there for buying Bitcoin or for repurchasing debt or repurchasing any security.
Yeah, that's definitely I think an important caveat to what happened. I mean, I agree with you. I think it's hard to see, too much constructiveness from the action of raising more cash for more runway right now. But to Mike's point, you've got a lot of different levers that you can pull with this type of strategy, for lack of a better term, and really, like, assuming things recover with Bitcoin price, then you get the reflexivity of that mechanism going back into the MNAV. Then things kind of, you kind of set sail and you kind of forget the past of what we were going through. But I'm not sure if the thinking then is to just give yourself a really conservative runway, and just in case this crypto winter lasts, longer than we expect. And you do that early on while the price is where it's at, and you kind of just set sail that direction. Um, Mike, I don't know if you have any final
Yeah,
takes on strategy.
I agree with Tomas largely in that I think there's diminishing returns in terms of increasing the U.S. dollar reserves. This is a new product that was launched sort of in the middle of winter, and so there's going to be a lot of growing pains, and they're trying to figure out what does the market need to return it back to par, right? So obviously having some reserves is good because that creates a certain level of confidence. Then maybe how much of it is reserves, how much of it is raising the rate. Um, obviously the Bitcoin recovery thing that's out of the control. Strategy can't control the direction of Bitcoin, but they can control the USD reserve and the interest rate. So I think they're just sort of, iteratively trying to figure out what the market needs to get it back to par. And it's a little bit of a confidence game too. If people believe it will return to par, then it will. Almost like inflation, right? Forward expectations can influence what happens today. So I think they're kind of figuring it out, and if it doesn't, then yeah, they're going to have to. I don't think adding any more money is going to make a difference to the reserves. So they're just going to have to raise rates, and that cash is just dead cash, right? That cash could be used to buy Bitcoin, which would benefit common shareholders. Instead, it's just sitting there. So this is one of the situations where it is beneficial to debt and preferred holders, but it's you could say not good or just slightly destructive to common shareholders, right? Having a large amount of cash just sitting there, especially if Bitcoin were to rally, gosh, then that could have been 3 billion in Bitcoin, right? That rallies instead of just cash.
Yeah, like opportunity cost.
Yeah, could potentially huge opportunity cost there. So it'll be interesting to see. I think the thing to watch really is just how long it takes Stretch to return to par, and how the MNAV behaves. Right now, the MNAV is trading at almost 1.0, using their enterprise value calculation. So they're probably very unlikely to issue more common equity in this environment. And if there's going to be any more cash raising, it'll probably be selling Bitcoin unless the MNAV returns to a premium.
Yeah.
That's a good close. Oh, sorry, Tomas, did you want to jump in there?
No, I think the only the commentary I made, definitely I would call it marginally like critical, but the I think make a good point, which is having more cash like does not harm the company. Like, just to be clear, it helps the credit profile of the company, the collateralization of the company, etc. I think from my perspective, when I think about like the different levers, the different angles on strategy, like right now at current market prices, they're already at, what they call 41% amplification per their dashboard. So that's already a little bit above their prior guidance around their target amplification, which I think was 30%. On the Bitcoin yield side, they're at 6.6 Bitcoin yield year to date, which is in like right in the middle of the road of where their annualized guidance has been historically. And so the additional incremental, common issuance that they did, which hurts Bitcoin yield, hasn't taken them like out of play from their historical guidance. And the only other thing would be that their net asset value premium is still pretty diminished. I think right now it's somewhere between 1.05 to 1.1. That's not their MNAV enterprise value, just to be clear. But it makes it harder for them to issue equity accretively. And so right now, like I said in previous sessions, in some respects for them, they can wait and see, and they're in a cozy position to do so. If you ask me, like marginally, what would they benefit from if they were to sell any of that 1.125 billion dollar Bitcoin authorization, or if they were to do any more common equity issuance? If I were in their shoes, I wouldn't um, spend more time trying to restock the nearly 2-year runway they have on dividends. I would just go and try to pick up some more of the convertible debt that's trading at a discount to par. Because I think everyone except for one series right now or two are trading at a little bit of a discount, and chipping away at that liquidity issue that comes up in the next, call it 18, 24 months, I think is more relevant today than it is um, trying to extend this runway on dividend payments.
To Tomas, I agree with you there. I think financially that makes sense to use that cash to pay down the convertible debt. But you'll also recall several weeks ago they did that. Right? I think they bought back 1.5 billion of convertible debt because it was trading something like 8% below, because of the price of Bitcoin, and the fact that it's very unlikely you'd actually be able to convert it into common equity. So it made financial sense at the time for them to buy down at 1.5 billion. But then the market kind of went up in arms because they want that cash to be put towards the dividends. So I don't know.
Well, let me just clarify the condition here being that when they did that, and I totally agree with you on how the outcome was seen and felt. My biggest surprise when they did that was that during that week where they retired the debt, they didn't issue any equity. And what threw me off was they had been boasting about this USD reserve that was like, I don't know, 15 months of coverage or something. And then they brought it down to 6 months. So they took like a long-term liquidity problem and accelerated it forward like a year and a half. And the only difference in this situation is the conditions that I'm saying under which they should buy this debt is they already have this USD reserve where they've put a policy saying that we're not going to take this money, this $3 billion, and put it towards debt payments. And so it's on the condition that if they were to raise any more money from here on, I think the best use of that money would probably be towards retiring debt, but you would still leave the USD reserve untouched because it's by policy not supposed to go towards debt payments. So they're not doing the trade-off on the liquidity side. I completely agree with you though on how the market received the last version.
Yeah, I agree. With new money raised, it should be put towards
Correct.
retirement, which has been what they've been trying to do for a while. Just switch from convertible debt to preferreds, right? That's the evolution. Okay.
Yeah.
Get to the prefs, yeah. Well, this puts us at time. Mike, I don't know if you've got, and also awesome discussion, by the way. I think we finished pretty strong. Do you have a second to give the audience on the things that you're watching for the week ahead, or do you have to hop to your webinar?
No, I've got a few minutes. Yeah, I think for the week ahead, obviously everyone's watching the FOMC on the 29th, but I think given the inflation data you guys were discussing earlier in the podcast, I think that's already priced in. I think the more interesting thing to watch is whether clarity gets Senate floor time before August 7th. I've seen a lot more talk of it lately. See Senator Loomis. I think Trump had a tweet where he was pushing it. So momentum is starting to build to get this thing to the floor of the Senate before the August recess, because after then, I think the odds of it passing drop precipitously just because of the terms coming up in November. So I see momentum starting to build. That's the thing to watch. I think it could be a great catalyst if it passes.
Mark, I'll pass it to you next since you're on the queue.
Yeah, I'm very similar. Number one is the Clarity Act. I think Trump is actually meeting with the Senate today, apparently. So we'll see if there's any news that comes out on the ethics provision. I believe that's the last thing that's holding it up. And then, yeah, number two is then going to be turning to watch and see what fund flows continue to do.
And Tomas, give us your quick week ahead.
With Mark on this near-term Clarity Act, particularly any outcomes of this like ethics negotiation. We've now that we're back in this like escalatory mode with Iran, the weekend operations continue to be a problem. So I would keep an eye out for what happens this weekend. It seems to start like an hour after Friday close every time now. And the only other thing I would say would be we start to see some of the hyperscalers release earnings in the next couple of weeks. I think Google's next week, if I'm not mistaken. And so keeping an eye on CapEx and sentiment around that ahead of the FOMC, I think is going to be a particular interest for financial markets for crypto.
Yeah, I don't really have too much else to add. You guys covered this pretty well. I think, earnings, obviously, next week, I see some blue chips coming in. So that's always fun to watch. You look at like some, I would say, legacy companies like the 3Ms, Lockheed Martin's, Dow, that's going to be coming through the wire. We're going into the quiet period with the Fed. So not much to take away there. Just maybe keep an eye on the rates markets. That's something that can kind of lead us around a little bit of what kind of shocks come out of the Middle East and how the market reacts with the term premiums in the rates markets. But that's really it. I want to thank everyone for participating. I want to thank the audience for listening in to another live episode. We really, really enjoy it. And if you have any comments or feedback, feel free to shoot them over. As always, do your own research and trade safe. Until next time, have a good one.